Welcome to the deep dive video update. And I always want to explain this right off the bat. My context of deep dive might be a little bit different than what you think. Every week I do a number of videos. I do a video every day. I do some weekly videos. This is one of the weekly videos where I go through the charts that are unique just to this video. But then some other charts are charts that aren't really speaking loudly to us right now. In the daily videos that I do, I try to pick out those charts that are really saying something to us. Well, this is a video where we have to dive deeper to be able to look and see, are we getting any clues from these other charts? This is being prepared for Monday, June 17th. Before I get started in the video, I do have a thing called the SPX investing program. This has launched as of the first part of June. It's free for the month of June. I will be locking it down in July, and it will be $97 a month, where you get first access to the daily videos that I do. There's a lot of other things. I have courses on there. I have trade ideas, position ideas that you might want to consider. And there's discussion that goes back and forth. So it may be something that you want to check out. It's not really active right now as I'm rolling things out. And there will be some things that will be coming as I have the time to post those things. If you're interested in that, you can send me an email. Here's an email address. And in the description below this video and every video that I post, there are links to a playlist on YouTube that talks about the program. And there's also videos available on Rumble that you can look at. And there's also a link that takes you to the site itself. So if you're interested in that, please feel free to check it out. The first chart that you see here is a chart of the VIX. I show this every week. This is more for informational purposes. The VIX is invisible on this chart. I plot a 50-period exponential moving average to give us an idea of what is the general range of the VIX. When the market's really going down, the VIX is in a higher range. When the market's going up, like it has been lately, the VIX tends to drop to a lower range. So that's just a helpful thing to know. We also want to measure the speed of the VIX, whether it's going up or down quickly. I use an RSI based on 9 periods, which is a momentum oscillator to show us what is the VIX actually doing. We look for extreme positive or negative readings. We're kind of in the middle right now, so this isn't really telling us all that much. We also look at the VIX and then a thing called the VVIX, which is like an indicator of the VIX, and then do a ratio between the two. In a general sense, when the VIX is going down with this ratio, that means the stock market is going up. When this is going up, that typically means there's pressure on stocks. Currently, we are declining with this ratio. And I look at the VIX and do a correlation with the S&P. Sometimes the VIX may not be telling us what we need to know, but we can often see something with this chart. It's not really telling us anything now. We pay attention to this when it gets above the dashed line, meaning the market is getting rather nervous, but right now the market is pretty complacent. Then on top is a thing called the MOVE index. That measures the volatility of bonds. The VIX measures the volatility of stocks. What I pay attention to is the correlation on the bottom. They're having a slight tendency to go in the same direction. Now, this does not measure what stocks are actually doing. This measures what volatility is doing. And we're seeing a little bit of a stronger relationship here as volatility in bonds has been dropping off lately, as well as volatility in stocks. We look at a ratio between the VIX and the MOVE index. And when this is below the moving average and the moving average is declining, that is typically more positive for stocks. So this is looking a little more advantageous for the stock market right now. And I look at a risk on, risk off ratio. I used to show this in the daily videos all the time when it was really moving around, but pretty much in 2024, it's been declining a little bit, but really chopping in a range. So we haven't been getting a lot of additional insight lately from this. And we look at high beta stocks. These are the stocks that outperform the market. And that's great when we're going up, but they also outperform on the way down when we're under some pressure. This has been chopping around for most of 2024 as well. So we're not getting a lot of additional insight from this chart. And we want to keep an eye on where are we in relation to the previous all-time high. We're up 12.72% from the high set in early January 2022. Then there's a thing called technical alerts, and I go through these in the daily videos each day as they come out. What you see here is for the entire week. And when we're going up, we tend to see more blue or green here. When we're going down, we tend to see more red. And we can just kind of glance at this and go, oh, yeah, we're seeing some negative things here. Oh, back here, we were seeing positive things. And then if you want to, you can actually go in and look at what is happening to cause these alerts. We read this from the bottom up. So the first signal that was triggered on Monday is at the bottom. The last signal that was triggered on Friday is at the very top. And I look at 5 main indexes. I look at a lot of indexes and a lot of sectors, but here stockcharts.com has this thing called technical scores, and it just looks at that chart from a technical analysis perspective and then gives it a score. The higher the number on a scale of 0 to 100, the better looking the chart. And we're seeing some real discrepancies here. There's some really strong parts of the market right now, and there's some really weak parts of the market. Coming in first place and looking really solid right now are the QQQs, which is the NASDAQ 100, coming in at 95. When we're at 90 or above, that means a really strong market, at least based on the QQQs. Then in second place, which there's a lot of NASDAQ 100 stocks in the S&P, we come in with the SPY, the ETF for the S&P 500. It's coming in at 90.3. So these two indexes are looking really solid at the present time. Now we start to really drop down. The Dow, which is coming off of setting an all-time high not so long ago, has really been languishing lately. And it's really breaking down as far as its score. If you remember this one, we had 90 up here. Now we drop all the way down to 31 with the Dow. And so it's in third place. And believe me when I say there's even worse scores than this. In fourth place are the mid caps at 29.6. This has been one of the stronger areas in 2024 up until recently. We hit the month of June and we went up from the 70 to 80 range, dropping all the way down to under 30 right now when we look at the mid caps. And even worse than that are the small caps, as represented by the IWM. That's the Russell 2000 ETF. This is really dropping off as well. Now, small caps has not done all that great in 2024, but this just shows that there's a lot of weakness in the market right now. So we have the Qs, which are at 95, and then we have the small caps, which are at 15. That's quite a wide range between the two, and showing some of the selectivity that we're seeing in the market right now, where it's a few of the really big stocks that are driving things higher, and that's helping the Qs or the NASDAQ 100 and the S&P 500 to look better, where the mid caps and small caps are not doing all that great, and the Dow is kind of in the middle because those really big companies that have been helping the market, they're not necessarily inside of the Dow since it's only 30 stocks. A short-term chart, this is a rainbow, and we're above all of the lines plotted here. These are moving averages going from 10 periods up to 50 periods. And this just suggests that the short-term trend is still positive. We're above all of the lines, and the lines are all going up. Some intermediate term charts, another rainbow going from 50 periods up to 100 periods, also showing that the intermediate term trend continues to be positive. We want to keep an eye on the 50-period moving average. Now, I've been showing this in the daily videos, and then I stopped because we're kind of getting far away from this 50-period moving average. Now, if we start to see some weakness, yeah, I'll be hauling this chart back into the daily videos to see if that's going to come into play. Right now, the market is dealing more with its 20-period moving averages, and those are shorter term. If we break that support, then we'll be focusing on the 50. The 100-period moving average, more longer term, intermediate to long term, we're well above that, and so there's been no need to show this chart. Then we have a momentum oscillator called the Connors RSI. We look for extreme positive or negative readings. Right now, we're just about in the middle. Point and figure chart. We did have an X drawn earlier in the week, and we're working off of a double top breakout that was generated on May 15th. And for right now, this chart is still looking positive, but it hasn't been changing all that much. when we saw that nice up day in the past week, we did see a new X drawn in here. Then we look at an anchored moving average going back to the previous all-time high. We're well above that. So I haven't been showing this. This differs from regular moving averages, where if it's a 10-period moving average, you take the last 10 periods to come up with the average price for right now. An anchored moving average goes back to a previous point and then projects itself forward, and sometimes that can be really insightful. Now, if we do get into a period of time where we're seeing some weakness with the S&P, I'll probably start picking some of these other tops that you can see on the chart to see if they end up providing some kind of support. I also have a couple of other anchored moving averages going back to the COVID lows. We are well above the 200-day moving average. So the long-term trend is still positive. We're green and coming off of setting really high readings. Now, don't get confused by this. This looks like a negative divergence where we're making a lower high when compared to the 200-day moving average. That's not necessarily true because the moving average itself, that's the red line that you see here near the bottom, it's going up. So that's why it's adjusting. And with price well above the 200-day moving average, I've just been glancing at this, but not showing it in the videos. The S&P 100 is doing quite well these days. It's breaking out and setting new all-time highs. These are the biggest stocks in the S&P 500, and that's helping. We're seeing a little bit of a divergence here where we're making a series of lower highs here with the S&P, where we're sideways to actually setting a little bit higher highs with the S&P 100. Just want to keep an eye on that, but that also confirms that we're seeing the bigger stocks really leading the market currently. Then we measure going back to the low that was set in October 2023 and the bounce that we've seen up off of that. And we're up well over, well, about 20, almost 25% from that October low. The mass index is not generating a signal right now. It does when we get up to the red dashed line and the blue line, and we're far away from that. So there's been no need to show this chart. The Pring bottom fisher, it was generating a buy signal, and that turned out to be a pretty good signal as we were going higher. Then it's not that this is a sell signal. It just means that the buy signal goes away. It's coming back down. Now we're starting to turn back up. Now this could be a little bit suspicious if we do see a cross with this, because this tries to pick a bottom in the market. Well, we haven't really been falling here. So I'm not sure if this will be a legitimate signal or not if we end up seeing a cross. We have the Ichimoku cloud. We're well above the green cloud here. This chart is used to show when we're going up and we pull back that often these areas will provide support. Since we're well above the area, I haven't been showing that. The next chart is it's a full study, and it actually uses some lines here. There's a little bit of a concern in this chart where we see the blue line above the red line, and that's positive. Well, earlier on in the week, before we saw the break to the upside when CPI came out, the red line and the blue line were getting pretty close to each other, and that was kind of a little bit of a warning. But so far, that seems to be taken care of when we saw the move up. We're also looking at the green line here, which continues to go up. So this is still positive, and we're well above the cloud. This is a newer chart that I wanted to also show, and I'm probably going to start using this at least for the next few videos in the daily videos, because we're seeing a real discrepancy here. The bar chart that you see is the S&P 500, and that's in black. This is the NYSE advanced decline line, which is different than the S&P 500 advanced decline line. Well, this is really going down with the advanced decline line as the S&P has been going up. That's just a negative divergence that we want to keep an eye on. Long-term, another rainbow chart going from 50 periods up to 250 periods. The long-term trend is still intact, and price is above all of the lines in the moving averages. This I was showing for a while, and then I dropped it out. And for most of 2024, when we take a 10-day average of the S&P 500 highs minus the lows, we've been getting a very extreme reading. That can also suggest good momentum. Well, when we started to see some weakness a month or so ago, we came down with this reading. We actually dropped below 0 or dropped below 50, the midpoint. Now we're starting to bounce back up, but we're not quite up into this extreme positive reading yet. This also suggests, at least for the time being, because this is a longer term indicator, that it's the bigger stocks, even in the S&P, that are really holding the index together currently. This is a special K, a long-term momentum oscillator that we use. We are continuing to be positive. And then here's a weekly chart of the S&P on top and the German weekly chart here in the middle area. And they had been showing a pretty strong correlated relationship, but now we're seeing that falling off recently. There's some upheaval going on with Germany's neighbor, France, and what's going to happen with some elections going on there. And there's even been some talk of France considering leaving the EU. That's producing some instability in the whole EU right now. And all European stocks have been under pressure lately. We look at some support and resistance levels. This is a 20-period simple moving average of the open, high, low, close. What that does is produce a little mini rainbow, and we're well above all of the lines in the mini rainbow, and the lines are going up. So this is still looking positive here. I just readjusted this since we set a new all-time high with the Dow with the S&P this past week. And if we start to see some weakness, we'll be looking at this 38.2% retracement level. And it's kind of interesting that as we keep going up, this previous low is getting closer and closer to being a retracement level, which if we do see some weakness, this could come into play at some future point as being a significant area of support. Some broad market measures. I was showing this for quite a while, but then I dropped it out of the videos. This is the QQQs, and we're above all the moving averages. I was showing this chart as the shorter term 20-period moving average dropped below the 50. And then I was also showing it again when we cross back above, and we're above all the moving averages here. So I stopped showing this chart. We'll look at the Vixen, which is the volatility measure for the NASDAQ 100, where the VIX is the volatility measure for the S&P 500. And we're kind of showing a little bit of an increase here because it's just a few stocks, even in the NASDAQ 100, that are really driving things higher. So we're seeing a little bit of a pickup in volatility there, but it's still quite low. This is the bank ETF, which has been doing quite well, and it's still in an uptrend with the blue line above the red line. But lately, we've been seeing some weakness, not only in the bank ETF, but a little bit of weakness with the financial sector, as the financial sector is dropping below its 50-day moving average. So we want to keep an eye on this area. And then we look at regional banks, the smaller banks, and compare it with the financial sector. And the regional banks are continuing to underperform. When we saw this really drop down, that was about a year ago when Silicon Valley Bank came out with their problems, and then Republic Bank. And then we were trying to have things look a little bit better. And then a few months back, when New York Community Bank came out with their announcement that they're having problems, that sent this ratio down again, and it really hasn't recovered to this point. And we're keeping an eye on some of these smaller banks to see if there's going to be some problems, because they needed interest rates to go down in 2024. And that may not end up happening, and this could produce some problems with the banks. Then we look at the S&P on top, and then a ratio between the Qs and the diamonds, which is the NASDAQ 100 to the Dow. And we're seeing that there's a pretty strong correlated relationship between the top chart and the ratio in the middle chart. And the transports have been really a disappointment, where the Dow, even though it's not doing all that great these days, it's doing better than the transports, which is the red line, and they are really underperforming the Dow right now. And then this is the S&P on top, or SPY, the ETF, and then we do a ratio between the SPY and world stocks, showing how the SPY, or the S&P 500, is outperforming other stocks throughout the world. Then we look at some rate of change charts here. These are just for information, where we go back 250 periods. We are declining just a little bit here on this chart, and we're coming down just a little bit on this other chart after we had come just slightly above this blue line. But this is just a longer term look at how things are right now. We keep an eye on bonds, where we look at TIPS. These are Treasury inflation protected securities. These are favored by investors when there's inflation and interest rates concerns. That's when we see this ratio going up. And then as those fears were getting more under control, this ratio was coming down. We're going back up again here. Now, there's another chart that I show tips to 7 to 10-year bonds, and that moves a lot faster. The movement here on this chart hasn't been as great, so I haven't been showing this chart. But we are coming down with this ratio. We want to see this go down if we're going to be in a more interest rate and inflation-friendly environment. And we look at the long-term bond ETF or the TLT. That's in blue, and then we have the S&P, which is in red. The longer term correlation is pretty strong. So we're seeing bond prices and stocks moving more in tandem with each other. But the shorter term correlation is actually dropping off a bit. And I have a couple of spread studies down below that I don't look at all that much. We look at the Qs and then the TLT. And there's also a pretty strong longer term correlation between the two. And then we have the US 10-year yield, and then we subtract the German 10-year yield. That gives us the line that you see on top. And since US yields are higher, that's why we get a positive result above this red line, which is 0. And then we look at the US dollar index, and there's a fairly strong correlation, believe it or not. This deals with interest rates, the dollar, which of course impacts interest rates. So sometimes we can get a little bit of insight by looking at this. And the dollar's been strong, but interest rates have been coming down lately, and that's been giving support to stocks. So we just keep an eye on what's going on here. This is the different, or these are the different yield curves that we have. The most important ones are the 10 to the 2 and the 10 to the 3 month. They're still inverted and have been now for a couple of years. This is a bit of a concern. Home construction, which is a very interest rate sensitive environment. It had been holding up quite well, but now it's coming back down into the middle of the rainbow. So we'll have to see if we can get a bit of a recovery going here if we're getting more to an interest rate friendly environment. Then the Eurozone, and we compare that with American bonds. They had been really doing well as the Eurozone was doing well, but with this recent instability throughout the EU, stocks have been under pressure, and so that's why we're seeing this ratio coming down. Then I have a number of things called possible positive scenarios, and these were really helpful back in 2022 when we were mainly going down, and then we would establish some kind of a bottom and come up out of that, and these charts can help us determine when that bottom is actually happening. But these charts are still useful on a day in and day out basis, but I don't use all of them. The rest of the charts are here in this particular video. This shows the percent of stocks in the S&P above their 200-day moving average. We're setting all-time highs recently with the S&P, and we're seeing this going down. That's a bit of a negative divergence. That causes us a bit of a concern right now. How I usually use this particular chart is we see this as an oscillator. We look for extreme positive or negative readings. We're still positive overall because we're above 50, but the fact that we're declining as the S&P has been going up is a little concerning. We do that same basic thing with a 50-period moving average study, also using it like an oscillator, and we're dropping down below 50 here. So this is showing some negative divergences inside of the market. We also look at this compared to the mid caps, also showing some weakness right now. And we look at this with the small caps, showing even more weakness. So this is some of the negative divergences that I've been seeing lately, and we have to follow price. That's the ultimate indicator. But these things are just suggesting that some weakness could be developing on different indexes right now. Even the stronger indexes are showing some negative divergences. And we look at the S&P and compare it with the 2-year Treasury yield. This sometimes when it spikes up and then comes down, that can give short to intermediate term support to the S&P. It really hasn't been moving around all that much, so we haven't been showing this chart. So thank you. I really hope you found this helpful. After this, I'll be preparing what I call the What to Watch video update, where the deep dive video talks about videos that I'm not really showing. The What to Watch video, it brings out the charts that I'm really showing right now and I'm really focused on. So I hope you're having a wonderful weekend, and I will talk to you in the next video.